So I believe we are live on our social media handles. Stephanie, I believe I can also share the hashtag for today, which is fine, right? NCBA FY 2023 financial results. We're good? Okay. Standard Media Group, Nation Media Group, Bloomberg, Abojani, Mwango, Capital, Royal Media, K24, Ramogi, Radio Citizen, Metropole, The Daily Nation, Business Daily, The Standard, The Star, People Daily, Karibuni, Bizna Press, AIB, Africa, Africa Report, Vipasho News, Bloomberg, Trading Bell, Karibu, together with your lovely crew. So we are already live. Thank you, Stephanie. We'll be kicking off at 8:50 as we wait for our NCBA executive team. All is set. Our agenda today is going to run for about an hour. So we'll start with our group managing director with an overview of the results. We'll then go into a deep dive of the financials. That's with our CFO, Mr. David Aboga. We'll then have a Q&A with the panel. So we have 4 panelists today. That's our group managing director, our group director of finance, our chief of staff and director of strategy, and our chief economist and acting group director for global markets, Raphael. So that's the team that will be on for the Q&A with the panel. Please have your questions ready. We have our oxygen team that will allow us ask questions, so they'll pass around the mics. Please introduce yourself, the media house you are from. And then let's give each other opportunity to ask questions. After that, we'll have our photo op for the panel right on stage. And then at this corner is where we'll have the interview with GMD. So all the mics, any questions, any last sound bites that you need, we'll have this corner with John. And then after that, we will get into one-on-one interviews. There's some requests from some of the media houses. And then we'll close with trading bells. And that will be it. So we should be done by 10:30. We will not keep you. We intend to start on time. Let's go for it.
At NCBA, we say, go for it. We're here to create a future where your aspirations meet their match in the world of finance. Our mission is to inspire you to achieve more with your money, ultimately enhancing your life.
As the Assistant Relationship Manager within the Premier Banking, I see the NCBA Service Charter as our commitment to becoming the pinnacle of our customer experience. We aim to elevate you to greatness through a seamless and a wow banking experience, driven by innovation and efficiency.
To me, the NCBA Service Charter embodies our relentless pursuit of excellence. We are on a journey to be recognized as the standard bearers of customer-centric banking. Our charter is a promise to inspire greatness in every interaction, to be your trusted financial partner.
As the Deputy Director, HR and Culture, the Service Charter represents our commitment to you, our valued customers. It means that your voice is heard, your concerns are taken seriously, and we are here to provide solutions with the utmost courtesy and efficiency.
For me, the Service Charter represents our commitment to always being there for you. It's about ensuring that whenever you reach out, you find our doors open and our channels accessible. We are here to bridge the gap between your questions and the solutions you seek, providing a safe and a respectful space for your banking journey.
The NCBA Service Charter is our promise to put you, our valued customer, at the heart of everything we do. We pledge to deliver the highest standards of our customer service at every touchpoint, guided by our promise to you. We know you, we back you, we will wow you. Your feedback matters, your rights are protected, and we are committed to not only meeting but exceeding your expectations.
The beautiful display of vehicles, spare parts, trucks, it's really mesmerizing. When you go around and look at the beauties which are here, they are just blowing your mind off, yeah?
The innovations that have been done since 5 years ago, just going around the new vehicles we have seen, talks of hybrid, talks of electric vehicles. NCBA has been at the forefront of driving electric vehicle adoption in this country, setting aside 2 billion shillings to support customers who want to acquire electric vehicles. And more recently, we announced that we are going to be rolling out charging stations. And indeed, we have already rolled 2 in our main center for customers and for the public.
That whole new infrastructure of electric vehicles is an area that we would like us to invest. Investment in new battery making technology. We would like to position Kenya as the manufacturer of electric motorbikes for Africa.
As we progress and develop the infrastructure, all the importers of new vehicles are actually gearing up to bring their different models of EV vehicles. And very soon, you will see at least 4 or 5 different brands putting forward their EVs on the road.
NCBA is the biggest financier of vehicles in this country. We like to brag that when you're driving, just count 3 cars ahead of you. The third one is probably financed by NCBA.
The coming of NCBA is an opportunity for our people to access financial resources, financial pieces of advice that are of value, and financial products that make our people grow.
Despite a very digital banking world, people still want their bank to be closer to them. It drives consideration. It makes it easier for you to access our services, especially when those digital channels, sometimes you need some assistance. People used to drive nearly 200 kilometers round trip, to Kisii. It takes so long to go and come back, and we were not that accessible, that convenient to use. With our presence today, we will be able to increase our support to the business community, to individuals, and to the larger society of Migori County.
We know the business is the engine for any economy. When we help the business to grow, then we are directly impacting with the society. We are partnering with even essential areas. We are funding the agriculture. We are funding the health sector, even to acquire equipment and acquire ambulances.
We want our people to grow economically. We want our people to invest in their activities and earn money out of those activities. I want to request the NCBA to reach out to our people. They may not know what products you're offering. They may not know how affordable your services are.
We are a bank that says go for it. We don't discriminate, and we welcome everybody to bank with us.
NCBA came to support us, especially when they opened the Kericho branch. We joined NCBA, and we have worked together through the journey, especially to the journey to West Valley Sugar Company. They gave us facilities which were able to run us through to make sure that we commission this factory. The journey has been very smooth because there are people who understand you. They will give you facilities depending on what you want, and also restructure them according to the need of the customer. West Valley Sugar Company is able to do 1250 tons per day cane, which we are going to produce about 2,000 to 2,500 bags of sugar. That is in a daily basis. We get our sugar cane from the Kericho region, Kericho, Nandi, and Nyando, actually the Nyando zone. Currently, we have about 7,500 cane farmers. They range from 1 acre to even 1,000 acres. But the bigger range of the farmers we are looking at are the small-scale farmers, 1 acre to 5 acres.
In terms of the contribution to the area, you just look around the area, you see a real town is coming up slowly. You can see people's lives are changing for the better. This factory is employing a lot of locals. NCBA's commitment is that it will continue to support the development of local industries, the development of local factories like this. And certainly in so doing, we also support the supply chain, such as the farmers, the hundreds of drivers that I see transporting sugarcane to this factory, and many other small trucks that are taking that sugar to the shops and other wholesalers. We'll also be supporting farmers in this region who want to get into the transportation business, to give them loans to buy trucks and to buy tractors. The sustainability of West Valley Sugar Company is to the farmer.
We are going to assist them in cane development in terms of giving the fertilizer, ensuring that they till their farms to the current way of cultivation, so that it makes sure that we get the right cane. We are going to give them renewable energy through bagasse to be able to light their families in terms of cooking and the rest. The technology we are using for this sugar is technology from India. This is more automated technology because most of the mill is automated in the factory, makes it to be efficient and able to produce more sugar and makes the factory to be more efficient. We are producing 3 megawatt power, which we use to run our own factory, so we don't use power from the government.
We need efficient sugar factories. That way, they're able to process cane at a reasonable price and therefore buy it at a good price from the farmers. So it can only help the farmers in the region. Thank you for being an integral part of the NCBA family. Together, we have achieved incredible milestones in building a bigger and more impactful business. I am immensely proud of what we have accomplished. Here at NCBA, we have identified sustainability as a key priority for our organization. It is more than a goal. It is recognizing that our license to operate is granted by the communities we serve. As a brand whose purpose is to inspire greatness, we have an opportunity to catalyze action towards a greener and more sustainable future. We believe that a sustainable future is a better future for everyone, that collectively we can chart a path forward to a more resilient society that can navigate the challenges of the future. That is why we're unveiling our sustainability commitments, our commitments to drive change and invest in our collective future. Through financing green projects and e-mobility solutions, we are doing our part to reduce reliance on fossil fuels. Our internal operations are also being retrofitted to reduce waste, enhance energy efficiency, and reduce our carbon footprint. We continue our tree growing efforts with an aim to grow 10 million trees by 2030 and contribute to the regional agenda for nature-based solutions to today's pressing climate crisis. But we can't do it alone. We believe that everyone has a role to play. That is why we are committed to working with you, our stakeholders, our customers, and indeed our communities. We've made significant progress, but there's still work to be done. So join me in changing the story by committing to do these 5 things. 1, becoming more energy efficient. 2, ditching single-use plastics. 3, becoming an avid tree grower. 4, thinking before you print. And 5, becoming a sustainability champion and evangelizing to your community. Together, let's build a culture of responsibility and impact that leaves a legacy for generations to come. Join me and change the story. A sustainable future starts by doing good today.
The beautiful display of vehicles, spare parts, trucks, it's really mesmerizing. When you go around and look at the beauties which are here, they are just blowing your mind off, yeah?
The innovations that have been done since 5 years ago, just going around the new vehicles we have seen, talks of hybrid, talks of electric vehicles. NCBA has been at the forefront of driving electric vehicle adoption in this country, setting aside 2 billion shillings to support customers who want to acquire electric vehicles. And more recently, we announced that we are going to be rolling out charging stations. And indeed, we have already rolled 2 in our main center for customers and for the public.
That whole new infrastructure of electric motorbikes, electric vehicles, is an area that we would like us to invest. Investment in new battery making technology. We would like to position Kenya as the manufacturer of electric motorbikes for Africa.
As we progress and develop the infrastructure, all the importers of new vehicles are actually gearing up to bring their different models of EV vehicles. And very soon, you will see at least 4 or 5 different brands putting forward their EVs on the road.
NCBA is the biggest financier of vehicles in this country. We like to brag that when you're driving, just count 3 cars ahead of you. The third one is probably financed by NCBA.
The coming of NCBA is an opportunity for our people to access financial resources, financial pieces of advice that are of value, and financial products that make our people grow.
Despite a very digital banking world, people still want their bank to be closer to them. It drives consideration. It makes it easier for you to access our services, especially when those digital channels, sometimes you need some assistance. People used to drive nearly 200 kilometers round trip, to Kisii. It takes so long to go and come back, and we were not that accessible, that convenient to use. With our presence today, we will be able to increase our support to the business community, to individuals, and to the larger society of Migori County.
We know the business is the engine for any economy. When we help the business to grow, then we are directly impacting with the society. We are partnering with even essential areas. We are funding the agriculture. We are funding the health sector, even to acquire equipment and acquire ambulances.
We want our people to grow economically. We want our people to invest in their activities and earn money out of those activities. I want to request the NCBA to reach out to our people. They may not know what products you're offering. They may not know how affordable your services are.
We are a bank that says go for it. We don't discriminate, and we welcome everybody to bank with us.
Thank you. Thank you, team. Good morning. Good morning once again to the members of the Fourth Estate. Karibuni sana to NCBA. We are about to start. It's 9 a.m. on the dot, so we are getting our NCBA leadership team to get here and we can start. I can see the team from Nation Media Group, the team from Standard, the team from Royal Media, Oxygen team, our online teams, Mwango Capital, Abojani, Soko's team is also here, I believe. Mark Otani, Karibu. I believe everyone has had breakfast. Nation team is here. I see Kefa. Bloomberg team, Business Daily, Nation Media Group, Karibuni sana. Our team from Oxygen, a warm welcome as always. That's a communications team. Our NCBA team from different departments. We have the finance team here. We have a marketing team here. We don't have HR, which is okay, we are good. So we are ready to roll. We are ready. Very good. So all set for those of us joining us live on social media. Our social media hashtag today is NCBA Full Year 2023 results, financial results. You can follow the proceedings. This will be a very brief update from our leadership team. We have 1 hour. We'll have remarks and overview from our group managing director. We'll get into a deep dive of the results. And then we'll have a Q&A with a panel. And we'll then close with photos and individual interviews. Thank you to our great crew and cameraman, Moses. I see Steve. Simon, well done. Standard Media Group. Karibuni. Steve is ready. Okay. Trading Bells team. Karibuni. So a few more minutes and then we start.
NCBA came to support us, especially when they opened the Kericho branch. We joined NCBA and we have worked together through the journey, especially to the journey to West Valley Sugar Company. They gave us facilities which were able to run us through to make sure that we commission this factory. The journey has been very smooth because there are people who understand you. They will give you facilities depending on what you want and also restructure them according to the need of the customer. West Valley Sugar Company is able to do 1250 tons per day cane, which we are going to produce about 2,000 to 2,500 bags of sugar. That is in a daily basis. We get our sugar cane from the Kericho region, Kericho, Nandi, and Nyando, actually the Nyando zone. Currently, we have about 7,500 cane farmers. They range from 1 acre to even 1,000 acres. But the bigger range of the farmers we are looking at are the small-scale farmers, 1 acre to 5 acres.
in terms of the contribution to the area. You just look around the area, you see a real town is coming up slowly. You can see people's lives are changing for the better. This factory is employing a lot of locals. NCBA's commitment is that it will continue to support the development of local industries, the development of local factories like this. And certainly in so doing, we also support the supply chain, such as the farmers, the hundreds of drivers that I see transporting sugarcane to this factory, and many other small trucks that are taking that sugar to the shops and other wholesalers. We'll also be supporting farmers in this region who want to get into the transportation business, to give them loans to buy trucks and to buy tractors.
The sustainability of West Valley Sugar Company is to the farmer. We are going to assist them in cane development in terms of giving the fertilizer, ensuring that they till their farms to the current way of cultivation, so that it makes sure that we get the right cane. We are going to give them renewable energy through bagasse to be able to light their families in terms of cooking and the rest. The technology we are using for this sugar is technology from India. This is more automated technology because most of the mill is automated in the factory, makes it to be efficient and able to produce more sugar and makes the factory to be more efficient. We are producing 3 megawatt power, which we use to run our own factory, so we don't use power from the government.
We need efficient sugar factories. That way, they're able to process cane at a reasonable price and therefore buy it at a good price from the farmers. So it can only help the farmers in the region.
Kote nchini matumaini, tujitahidi, tujivunie, tuendelee mbele, twende mbele, 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 tuendelee. Twende mbele, 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 twende mbele, tuendelee. Mbele, Kenya twende mbele.
Kenya
Tuendelee.
twende mbele. NCBA, go for it.
Ladies and gentlemen, good morning. Good morning to everyone. We are now ready to start. Welcome to the bank that says go for it, or Twende Mbele in Swahili. Our executive leadership team. So today we have our group managing director, Mr. John Kashora. We have our group director finance, David Abuoga. We have our chief of staff and director of strategy for the group, Louisa Wandabwa. We also have Raphael Agung, our chief economist, and our acting group director for global markets. Karibuni sana to our executive leadership team. My NCBA colleagues from different departments, welcome to today's event. Members of the Fourth Estate, it's good to see you once again, and thank you for those who really made it early today. Abojani, Standard Media Group, Nation Media Group, the crew from Trading Bells, Royal Media Services, a lot of you. Thank you so much for being here. My name is Nelly Wainaina, and I'm the Group Director, Marketing, Communication, and Citizenship at NCBA, the bank that says go for it. Welcome to our full year 2023 financial results. I know everyone has been waiting saving the best for last as we get towards Easter. So welcome. And for today's events, we aim to provide valuable insights. We aim to highlight important developments for the business and also to look at the achievements that we made in 2023. On behalf of the Board of Directors, the Executive Committee represented here, and the staff of NCBA, we thank you for being available to join us at this event. Today, we'll kick off with remarks from our Group Managing Director, Mr. Gashora. We'll then have a deep dive into our financial results for 2023 with our CFO, David. We'll then get into a Q&A. So for the Q&A, we'll have 4 members of our executive team. We'll have Louisa, we'll have David, we'll have our Group Managing Director, and we'll have Raphael. For the Q&A, again, introduce yourself, the media house. We have our Oxygen PR team here to ensure we have all the questions answered. Please take your time and please answer and ask as many questions as possible. This is your great opportunity. After the Q&A, we'll have a photo op with the panelists, and then we'll go into one-on-one interviews. There was some requests for interviews from some of the members of the media. We'll then have a final interview with the Trading Bells team, and then we should be able to close by 10:30. So we will not keep you here for long. And today's social media hashtag, I know we have a number of people watching us live online, NCBA FY 2023 financial results. Tag us, watch the results, share your comments. We really, really do value us. And this is why we are ready to share our results today. And so without further ado, I'd like to invite our Group Managing Director, Mr. John Kashora, to start with an overview of our results. Thank you.
Thing working. Good morning. Yeah, can you all hear me? Very good. First of all, let me thank you for taking the time to join us this morning, to come listen to our wonderful story. I recognize that there are a lot of competing events this morning, and the fact that you chose to come listen to us, we really don't take it for granted. So I want to say thank you for coming. We shall be fairly quick, but do bear with me that we do have a long presentation, but we'll go through it very, very quickly. Let me start by, we'll start by talking a little bit about who we are. Then, as Nelly said, we'll talk about the operating environment. I'll give a bit of update on where we are on strategy, and then we'll go through the numbers that matter. So our CFO will go through that a bit more deeply. But I think, let me start with key messages for today, because at the end of the day, what we want you to take away. One is obviously that it's about our performance. For 2023, we had a fantastic year. We are reporting profit after tax at 21.5 billion, which is 56% up year over year. That's perhaps, I've looked at the numbers and I believe is the best performance of any bank group in Kenya so far. So 56% up year over year. I think we deserve a clap. I know you don't like to clap. Surely that's really good performance. Return on average equity at 24.1%. Again, one of the highest in the industry today. So again, really good performance. Subsidiary contribution. I think last year when we met, we talked a lot about what we were doing with subsidiaries, because at that point, subsidiaries made only 0.5 billion, $500 million in contribution. And if you recall, the regional subsidiaries were actually a loss of 380 million. In 2023, those subsidiaries delivered 4 billion in bottom line contribution. And all these has led group board to propose a dividend, final dividend of 3 shillings per share, and added that to the interim dividend of 1 shilling 75 cents. So fully a dividend proposal of 4 shillings and 75 cents. So again, very strong return to our shareholders. All this, the underlying performance showed significant momentum in basically all our financial drivers, bigger balance sheet. Our deposits came in up 15% year over year at close to 580 billion. Increased lending up 20% year over year at 369 billion. Digital disbursements continue to grow. I know when we met a year ago, you all had many questions about how Hustler Fund is going to eat into our digital business. As you can see, we have outperformed at 27% growth year over year. Very well controlled credit risk, which has been a big discussion for the industry and of course for us, at 12% NPL ratio. All this, again, meeting our ambitions, bigger branch network, and we'll talk a little about that. 8 new branches opened in 2023. Continue to lead in asset finance, in digital banking, in corporate banking and wealth management. And of course, as we have always said, very strong investments in customer experience, which we are proud to say is a defining factor. And finally, we'll talk a little bit about our sustainability agenda, which we launched last year. So quickly, just a reminder of who we are. I know you all sort of know who we are, so I'm going to be very quick through this. We have a group, NCBA Group PLC, with banking subsidiaries in Kenya, Rwanda, Uganda, Tanzania, and our digital banking business, which we don't report as separate business, but we run it as a separate business. Then we have non-banking subsidiaries, our leasing business, investment banking business, bank assurance intermediary, and as you all recall, we announced that we're going to be acquiring an insurance company as well to add to this table. We are the bank that says, help me, we're the bank that says, that is a bank, a financial partner that inspires your growth, that we believe in everything we do, that the customer is at the heart of it, with a promise to back our customers, to know our customers, to back our customers, and to wow our customers. Hopefully, last time I challenged you to try us. If you hadn't, hopefully you have seen that this is a true promise. We live to this promise. So very quickly, as you can see, a large business. We cover both East and West Africa. We're one of the few businesses, banking businesses, that have gone east, have gone West Africa from East Africa, with presence in Ivory Coast and Ghana, and of course the region of East Africa, as I said. 100 billion in capital, 100 billion shillings in capital. Deposits, as I said, 597 billion. Actually, that should be 579, I believe, billion. So close to 4 billion US dollar in deposits, 370 billion in lending, and digital disbursements, as I said, of 930 billion. If we turn to awards and accolades, it's important to see that we're being recognized. We're one of those organizations that don't try to get accolades, so we are very lazy to participate. We get invited a lot to participate, and we don't. So when we get accolades, it's because people really do recognize that we have done what we said we'll do. So first of all, let me say I was recognized as most influential CEO impacting business, and I thank Business Monthly magazine for that. And also at the beginning of the year, last year, I think Abojani also named me CEO of the year. So I appreciate that very much. Winner, Best Customer Experience Strategy. Winner, Best Customer Service Week Innovation in the Institute of Customer Experience. Something we're very proud about, because for us, customer experience is at the heart of everything that we do.
On ESG, having launched our strategy last year, we were named the best bank corporate governance in Uganda, seal certification in gender equality in Rwanda, and sustainability signatories for the UN Global Compact last year. And of course, on business unit recognition, there were many, but just to name a few, we were named as a winner, Private Sector Legal Department of the Year, Best Digital Bank in Tanzania, and winner, Company Secretary of the Year, again, speaking to ESG commitments. The people that work to deliver these results, the ones that you see on the board. I guess in the room, as Nelly has said, David Abwaga, our Group Director of Finance. We have in the room Louisa Wandabwa, our Director of Strategy and Chief of Staff. We have in the room, of course, Nelly Wainaina, our Group Director, Marketing, Communications and Citizenship. Have I left anybody else? We have Rafa Lagung, who is acting for global markets. Anybody else have left on this? I don't think so. But that's the team that delivers. So I'm here just delivering the message that they have given me to deliver to you. So let's go to the meat of the presentation, but let's reflect a little bit on the operating environment that we find ourselves in. I think, oh, it will refuse to move. Okay. The operating environment, I think turning to the global operating environment, I think we are seeing in 2024 accelerating global growth expectations. Having gone through a very tough year last year, I think we talked quite a bit about the US and how they are doing. We have seen inflation in the US come down, has been the debate for the last few years actually. And I think the bets are that the Fed will start loosening and moving away from their tightening stance that they have had for the last 2 or so years. We expect that even the thought of higher for longer may not be true, that in the second half of the year, the Fed will start loosening their market stance. If you turn to Kenya, the same story, whereas we have seen divergent growth forecast, one thing is very clear, that everybody expects that Kenya will perform better this year than they performed last year. Last year, we expect the final number to be at about 5.6% GDP growth. This year, we're betting on a 5.7 GDP growth. That seems to be the agreed forecast for Kenya. And of course, the region, a very good forecast for the region. I think if you turn to interest rates, again, a big debate last year, we saw quite a bit of tightening coming from the Monetary Policy Committee, including this year where there was a raise to CBR to 13%. I think the belief now is that the CBR will hold for a period and then start coming down. We don't expect CBR to go any further. And I think you've seen, even in the auctions that the CBK has done, they have started putting some screws on the rise on interest rates. Uganda has also acted after being flat for quite some time. They have raised their interest rates, but that's really because of the performance of the Uganda shilling, which had been stable throughout the period, except this year we have seen some volatility in the Uganda shillings. And finally, the regional currencies that we have seen, full depreciation, especially in Kenya and Rwanda. As I mentioned, Uganda, we are starting to see that this year. Tanzania has been fairly constant, but we know there's a lot of intervention from the government, from the central bank in Tanzania to keep it that way. But Kenya, obviously, this year, you know the good story after the performance of the IFB and the performance of the Eurobond, that the shilling has strengthened quite strongly. It's trading in the 130s now and seems to be holding in the 130s, and we'll talk about it a little bit more. So let me then talk to our strategy. Where are we on strategy and how are we executing on our strategy? First of all, let's look at our strategy execution between 2020 and 2023. Our strategy was a 5-year strategy running from 2020 to 2024. So these numbers are really to demonstrate how we have executed during that period. Our profit after tax, 2020, we reported 4.6 billion. We are now reporting 21.5 billion. Our return on average equity, 6.6 billion in 2020. And as I just mentioned, today we are reporting 24%. And as you can see, the areas that we have driven very strongly, the NPL ratios have come down. Our cost of risk has gone from 7.4 to 2.6. So those are some of the areas we have driven very strongly, adding to the customer franchise growth that we have seen. Talking of customer franchise, our focus on expanding our branch footprint has grown our retail banking customer base and delivered very tangible balance sheet growth. What you see here is on your left, you see the growth in terms of our footprint. The dark blue talks to the counties we were in. So in 2020, we were in 15 counties in Kenya. Today, we boast that we're in 26 counties. So we've grown quite significantly during that period. Our branch network has grown from 71 branches to 92 branches. Not to mention, during that time, we have closed 16 branches. So you can see net addition is quite significant number of branches. What has that done to customer numbers? Our customer numbers have grown from 220,000 customers to now 310,000 customers. So significant growth in customer numbers. Speaking to the branches that we have opened, because I've been asked that question before, how are the branches that you open performed? So the graph in the middle, the bar chart in the middle actually shows the performance of our new branches. Okay? Having opened 25 new branches, how have they performed? You can see each quarter the net profitability, operating profit of those branches. And I'm happy to say in Q4 of 2023, the composite performance of the new branches turned positive. So those branches are basically now able to pay for themselves. So I hope the question on performance of new branches now goes away, that they're actually able to pay for themselves. And that growth of branches has resulted in what we call network effect. We have seen more customers come to us, not just through the doors of those new branches, but including our old branches. They're using us more because we are in more areas where they do business. So the network effect, as we describe it, is that our retail business has become one of our most profitable businesses. As you can see, the bar chart shows the growth in terms of deposits and loans, and then the line chart is showing the contribution of our retail franchise to the bottom line profitability. In 2023, our retail business has contributed 23% of our profitability. So it's one of the most profitable businesses that we run. Turning to our other theme, corporate banking, we are the #2 corporate bank in East Africa with a substantial deposit base, 206 billion, which grew 20% year over year in 2023. And more importantly, is that even with that growth did not come just in Kenya. We grew our cross-border relationships significantly, as you see on the extreme right, where in 2022 we had 55 of what we call cross-border customers. These are customers we bank in Kenya, Uganda, Tanzania. That number has grown to 71 customers during that time. And below you see how those customers in what industries those customers come from. Our other sweet spot, as you all know, is asset finance. How have we done on asset finance? One, we continue to expand the number of schemes, having grown those schemes from 9 schemes to 15 schemes in 2023. Our market share continues to be very strong. In 2023, our market share recorded at 34%. But let me give you context. At 34%, the next bank is about 23%. So it's quite a significant jump between us and the next bank. And if you track who is the next bank, that name changes from year to year. So it's not a consistent one bank. The consistent bank is the leader, who is NCBA, at about 30% leadership in asset finance ecosystem. It's a very diverse portfolio, as you see, which we've been growing significantly. But more importantly, the very last graph shows our risk performance as far as this book is concerned. Our cost of risk has come down significantly from 2020, 4.6% to now 1.2%. So it's one of the most healthy balance sheets that we hold, which is asset finance, which means we understand it well, we know how to lend, and we also know how to collect as well. Turning to our other thrust, strategic thrust, is on digital transformation. And we have made a lot of digital investments in our core bank, which have improved process efficiencies, reduced costs, and of course, trying to address what is most important to us, which is customer experience. Modernizing our infrastructure, we have invested over $18 million in that, whether it's cloud migration, data quality management, our server upgrades. A lot of investments have gone towards addressing cybersecurity threats, having signed up to a security operations center, a lot of security assurance work that we do, vendor management controls that we do to ensure that we are well protected from our cybersecurity threats, and of course, investments on improving customer experience. Directly, we have invested $10 million towards that, leading to some of the awards that I mentioned before, including new ones like being ranked as a market leader in corporate banking by offering digital solutions by Euromoney. So we continue to do a lot of investments in that. Now, turning to the digital banking, as I said, we run it as a separate entity. So our investments in digital banking, as I said, helps us disburse $930 billion in 2023. That is up 27% year over year. And here I'm providing a breakdown among the various offerings that we have, whether that be Fuliza, where we disbursed $789 billion in 2023, Mshwari, $102 billion, Loop, $1.2 billion, and then in Uganda, we run that product as More Cash, in Tanzania as Empower, Rwanda as More Cash, and in Ivory Coast and Momo Cash. So those are the products that we offer and we call our digital banking offering. And hopefully you have had a chance to take a picture of that page, because I know you'll all ask me about the breakdown. Yeah. And then continuing to develop this heritage in digital banking. Last year, we rolled out our Loop Super App, which I hope all of you are using. And we have seen significant growth in that Super App. Buyers count. Buyers are the customers basically on that app, growing from 269,000 to now 304,000. Obviously, the market leader, you all know who that is, will be Safaricom at 32 million. A merchant count, we have merchants on that Super App as well. We have 10,000 merchants already signed up in less than a year, with the market leader having 252,000. So we're growing significantly and very good returns. If you look at average revenue per user, that is what ARPU stands for. Very healthy numbers. You can see we are doing better than the market leader on what we call ARPU. So it's important to capture that number. Let me then turn a little bit to our sustainability agenda. As I said, I'll talk a little bit about this. As you know, we launched our sustainability agenda last year in September. Under our sustainability agenda, we set 5 pillars: minimizing our direct impact on climate and amplifying our tree planting program, igniting our customers' transition to a low carbon operating model, mitigating the impact of climate-related risks to our long-term performance, enhancing impact of our community, or our own impact on the communities, and therefore enhancing a community engagement model. And of course, as we talked about corporate governance, optimizing corporate governance to deliver for the long term and sustainably. I think what you see on the right are some of the impacts we have had. Last year, we planted over 344,000 trees, ourselves plus our partners, working with partners. 34% waste recycled now at our headquarters, and we're driving that quite significantly. 76% reduction in plastic use in gifting. So the gifts that we give, we track how much of plastic that we give on that. You're aware of our 2 billion commitment of electric vehicle loan portfolio that we're building. And then we have 4 electric vehicle charging stations installed now in Nairobi and Kigali, Rwanda. So we continue to make quite a bit of investments in those commitments that we made last year. The other things I think we're well known for is, of course, scholarships, supporting over 100 students, 7,000 plus players in our NCBA golf series. That's a very big number. And more importantly, of those 7,000 players, 3,000 of those are children that have participated in our junior tournaments over last year. This year, we're investing quite a bit more, where we're doing some work for what we call elite amateurs, so that actually golfers can start earning a living from playing golf. And that's a project being led by NCBA. So doing a lot of work that's benefiting the communities that we serve. You saw an announcement recently that we have signed a facility agreement with Proparco, $50 million facility agreement with Proparco to mobilize funding towards sustainable financing. This financing is meant to go 40% towards green projects, 30% women-related projects, and 30% to SMEs. So we're really keen to ensure that our commitment to mobilize 30 billion in sustainable financing by 2030, that commitment is met. And this is just a beginning, a step towards that commitment. Turning to our staff, we have maintained a high performance culture. And I think what I want to draw attention to is that we have grown staff numbers to 3,200. And if you look at the number of staff therefore added, between 2022 to 2023, we have added over 200 permanent staff, over 200 permanent staff. And if you add the non-permanent staff, I believe we have grown our staff by about 400 staff. So we continue to be big on job creation, and not just job creation. On the right, you see our own staff continue to benefit from promotions, 448 promotions. And then our internship program onboarded 61 interns last year, all of whom ended up getting permanent positions either with the bank or elsewhere. So it's really creating a great pipeline for the industry. Our gender split, we are a 50-50 organization. Yes, it's 51-49, depending on which day of the week you check. We are basically a 50-50 gender split organization. And I've described before that our pay policies are name blind, in which case you will never find that women are paid less than men at NCBA. We are completely gender name blind when it comes to pay policies, the way we do our pay. I want to talk a little bit about AIG. We announced that we're going to be acquiring AIG Kenya business. We're still on track, hopefully to close that in the second quarter. I just want to talk a little bit about what strategic drivers were behind that decision. One is that we believe NCBA should be a universal business model. The type of customers we serve today are looking for solutions, financial solutions from one place. They want to talk about their insurance, they want to talk about their deposit, they want to talk about their investments, they want to talk about many other things, all in the same place. And so for us, it's really creating that universal business model so that a customer does not have to keep calling 6 people to address their financial needs. Scaling distribution. Without distribution, we believe we are able to distribute more products to our customers. Our own motor ecosystem is very big business. As you know, we're talking about asset finance and of course our corporate bank. And those customers, we believe we can offer them a much better experience from an insurance offering proposition today, and they were, because they've been asking for it. And finally, we believe that we can help expand the reach of insurance because we can use our digital capabilities, which we have been ranked #1 at, to develop digital micro lending and basically develop better reach on digital. So finally, if we reflect of last year, every year we come up with what we call key priority or thematic areas that we focus on. So last year we talked about, or we really spent a lot of time on balance sheet optimization, basically enhancing the value generated from our balance sheet. And I think our results today speak a lot to that. Customer growth. I've talked about customer growth from the expansion on new branches and many other activities that we undertook last year. Controls, I talked about that last year, that we are going to be very focused on making sure we manage risk. And as you can see, our cost of risk has come down. Our NPL ratio, as we say, 12%, when the industry is growing at about, it's now about 15%. We are 12%. Let me talk about subsidiaries contribution. And as I have just demonstrated, a subsidiary contribution went from $500 million a year ago to $4 billion that we are announcing today. And then sustainability was the other big focus. And I think I've dealt quite a bit on some of the things that we did on sustainability. All these, obviously, we aim to grow shareholder returns. And I believe, again, from the results we are announcing today, you bear me witness that we have delivered. And with that, I'll ask our CFO, David Abwoga, to come forward and talk a little bit about the numbers that matter. Welcome, David. Thank you.
Good morning. It's always a pleasure to be here discussing with you our full year financial performance. And I'll just try and pick up from where John has left off. I think he's given us good insights about the operating environment, strategic thrusts, and more importantly, the last slide that he put up, which was what were our priorities in 2023. And so as I speak through the outcomes, it's sort of looking at how do we perform vis-a-vis those priorities. I think this is a good place to start, right? And if we ask ourselves, you want me to use this one? Okay, fine. Is that not better? Okay, good. So this is a good place to start. Where did our growth come from? From an entity or business unit contribution come from last year? John did mention, so 25.5 billion of profit before tax, but a PAT of 21.5 billion, which was 56%. That is the overall message. But where did this come from? We organize our business into, I would say, almost 3 parts. We have got the core banking subsidiaries. This is all the core banking in all our markets where we have presence. So Kenya, Tanzania, Uganda, Rwanda. And then we've got the non-banking subsidiaries. That's our investment bank, insurance intermediary, and the leasing, and the digital business, which we track sort of as a separate unit on its own. Just for you to get a sense of country contribution, like Kenya, you'd have to add Kenya the core bank plus the digital business, that is what would be your bank in Kenya, right? And Tanzania, the core business plus the Empower contribution, that would form what is your core bank in this market. But from a core banking subsidiary, if I was to begin there, I think all our core banks delivered a 22% growth. We're at 20.4 billion of PBT contribution. Kenya at 5%. But I think the significant message here really is that if you look at Tanzania, Uganda, Rwanda, and John has already talked about this, even from a core perspective, that's almost a 1.2 billion contribution versus a negative 1.2 last year. So that's a significant shift and contribution from just the region across. The non-banking subsidiaries, again, 40% growth from a profit before tax over last year. Investment bank, driven by the wealth offering, the advisory and the brokerage business in that entity, 19% up over where we were last year. Insurance intermediary, again, 130 million increase in profitability, which just really talks to a lot of continued customer retention for that, for our intermediary. And leasing, which is very closely related to our asset finance business, a 43 million increase to almost 150 million profitability. So we've seen growth even in the non-banking as we, move towards this universal offering that John did talk about. Yeah. Excuse that from where I come from as well. Digital banking. So again, we track our digital banking. So this still sit under the banking entities in all the markets. I mean, if you look at digital business Kenya, it's still part of the banking business in Kenya. 3.9 billion last year, we're at 2.6 billion. You could ask the question, we saw good numbers from disbursements. So what happened? Why then is the profitability of the digital business in Kenya not reflecting that disbursement? I think I would say two things. This is one business that we've invested heavily in. A lot of the investments that you saw up there on the technology side, majority of them are sitting in this digital business Kenya. And it's really investing for growth. That's one. So that does impact, the bottom line. But secondly, on one of the products in Kenya, for example, you are aware of those significant fee reduction as well. So that does, despite volumes, but because of that fee reduction or the charges reduction, then it does impact your bottom line. You see a red on Ghana. Ghana is because it's still a startup, not operational yet from a business sense. So these are really formation costs in there and setup costs that you see under the digital Ghana. But I would like to highlight that from the other markets, Empower in Tanzania, Mokash in Uganda, and Mokash in Rwanda, these are now contributing almost 40% of our digital business profitability. And Kenya is just now cutting 60%. I think this screen has gone off. Okay. Kenya is 40% of that profitability. Kenya is 60, and the region is now contributing 40% of that profitability. This screen is playing up. Just give me 1 second. Yeah. If I move up to then what is Kenya versus the rest of the subsidiary contribution to our performance, and where have we come from last year? Last year, Kenya was 98% of PBT for the group, with a drag from Tanzania, making the regional banking subsidiaries 1% contribution, and the non-bank was 3%. Tanzania, as you saw in the previous slide, has significantly turned around. We did make significant investments in 2022 from a capital perspective. We retooled that business. We looked at the model. We had a staff rationalization in that market, and that has begun to bear fruit, and Tanzania is now a profitable business. If you look at this year, then Kenya is an 85% contribution to our profitability, and the rest of the subsidiaries are now up to 15% contribution. If you compare this to total assets, Kenya is about 90%. It's still the flagship of the group, 90% from a total asset perspective. But you can see that the 10% of assets now, all the investments in these other markets have now contributed positively from a bottom line perspective. This just delves a little bit deeper into that. Where does the revenue come from? Kenya contributes 53% of our total, 53 billion, sorry, not percent, 83% of our total revenue. 83%, now if you relate this to 85% of total assets, and a similar sort of percentage from, no, sorry, 90% of total assets and 85% of profitability. But it's still the flagship. But our Uganda, Tanzania, and Rwanda banking entities, from a combined perspective, there is a 13% contribution, and then our non-banking subsidiaries, from a revenue perspective, 3%. And all very highly profitable from a return perspective. Kenya Bank at 22%, contributing to that group 24%. You see a bit of an outlier on Tanzania, and I could talk through that a bit. Yes, there's profitability, but we also had a significant credit on the tax line. This is due to resolution with the Tanzania Revenue Authority on some long outstanding tax matters. So there was a credit on the tax line. If you normalize Tanzania, it was about 18% from a return perspective. We also track efficiency. The group's target near term, as we've said from our guidance, is 45%. Depending on the stage of maturity of our various businesses, we target at least the rest of the entities to be at 50% from a cost-income ratio. So Uganda at 56%, Tanzania at 70%, are slightly above what the group target is. And we are working towards improving productivity in those markets to make sure that that cost-income ratio comes down to 50%. Kenya, because of the investments we are making, and we did highlight this, would initially be in the 45% region before we start driving it down back to the 40% that we were a couple of years back. If then I delve into a little bit about what are the components of our income, what are the components of our balance sheet. On the right side, the group is now 735 billion from our total asset. I was just doing the maths. If you use January's exchange rate, you're a $5.5 billion business. If you use today's exchange rate, no, if you use January, you're a $4.5 billion business. If you use today's, you're a $5.5 billion business. So averagely, we could say we are a $5 billion business across, right? And our group assets were up 19% over last year, driven by a very, very solid customer deposit base and funding at 579 billion as a key driver of that asset growth for the group. That is a plus 76 billion of deposits across the group. And we saw this across all our markets from a growth perspective. Now, granted, there'll be an element there of currency, because the currency depreciated, and if you have dollar deposits, obviously, then there'll be an element of growth attributable to currency, but still a very, very significant growth from even a business as usual perspective if you take away the currency. Lending, I think John did talk to this, plus 62 billion of credit extension. That is a significant growth across the group, and principally to support our customers across, support their needs. The element of FX in that is not much. It's a small contribution of that. But just to give you some color, the regional subsidiaries in these assets, I mean, they contribute probably just now under 100 billion of total assets. Our banking subsidiaries in the region of the 735 billion. With the fastest growing there really being the Rwanda business. I think Rwanda from a total asset size has expanded almost 56 or 51% thereabout. Yeah, significant growth in that market. So if I turn then to the left from just where is our income, we had a 5% or 3 billion increase in our total income. We are now at 64 billion of total income. and a PBT of 25.5 billion, as I mentioned earlier. If we go a little deeper, and let's talk a little bit about customer growth, our deposit mobilization efforts that have led to this 15% year-on-year growth. I think John did mention ours is not just a deposit gathering business, but trying to ensure that we are providing services to our customers across all their needs. You'll find that a lot of this stock of deposits is really operational accounts and institutional accounts from our customers. And then you layer on the personal banking side, and also the digital business has almost a 10% contribution to this customer deposit number across our group. So despite the very harsh macro that was informing the operating environment last year, I think the group was able to layer on an additional 76 billion of deposits. I think the good news, and we've had these conversations in the past, has been our CASA versus term, and do we have sustainability in terms of our cost of funding and where is that going? I think we are very encouraged by the positive. You can see a 25% growth in our CASA from a quantum perspective. From a growth perspective, faster than what we layered on from a term deposit perspective. So that is encouraging and good. And it talks to some of the investments we're making in even the branch network. All the branches that we've opened in this strategic cycle are beginning to contribute positively to our funding mix. And that will become important even as we drive value or extract value from these branches and these investments. On the lending side, in the beginning of this strategic cycle, I think our growth credit extension was very mute. And we were then grappling or dealing with a few credit quality names, which we managed to get over, and are now on a sustainable path of growth from just meeting our customer needs and expectations and helping them, grow their prosperity as well. So again, 62 billion or 20% of growth in lending across the group. But despite that growth, if you look at the top bar, 2021, an NPL ratio of 18.1%, down to a 12.1%. That's a significant improvement in credit quality and credit extension, which is one of the things, if you look at John, when he put down the priorities under controls, credit quality was one of those control elements that we said we will go after last year. You can begin to see that improvement in our portfolio. If we compare, and the graph on the right is just looking at ourselves versus where's the industry from non-performing loan ratio. I think the latest statistics we saw from the regulator was that the industry is at about 14.8% of non-performing loans. We've made a comparison, Peer 1, Peer 2, Peer 3. You can see there's a range of performance across the industry. We are probably somewhere in the middle. We've seen high NPLs of 17 to 20% amongst our peers. But we also know that there are some peers who are also in the single-digit NPL. And so our target really is to continue driving that ratio downwards. As we talk about credit quality, because I think a lot of your questions in the past center around this, I would say that 88% of our credit portfolio today is performing. 88%, despite that growth in lending. Secondly, you'll ask, where has this NPL grown? We've grown net-wise, 6 billion increase in our NPLs to 45 billion today, right? If I talk about three factors that have led to that growth, one is just the shilling and the depreciation of the shilling. You do have dollar-denominated non-performing loans, given where the currency shifted. If you layer that on, we had almost just a 3 billion increase in non-performing loans. That is just due to currency shift, yeah, because of our dollar non-performing loans. From a net movement, net downgrade, and we call it net downgrade. So this will be a function of the gross downgrades minus recoveries and upgrades, right? Was 13 billion. So it means 13 billion of performing loan book became non-performing in the year. And lastly, we wrote off about 12 billion of non-performing loans. Why do we write off non-performing loans? It's a variety of reasons. One is there's a prudential requirement, but secondly is that you have actually reached a settlement with a customer and they've paid their part of the bargain and the remaining stock, then you'll not collect it, so you write it off. You could also have a result of a legal outcome. I mean, you've been litigating and there's a settlement by the courts, and so the balance, then you have to write it off, right? So there are a variety of factors why then you would actually write off some of the, instead of continuing to hold them onto your live book, so to speak. It doesn't mean that you write off and forget for a majority of them, is that you write off, but the recovery effort does continue. So there's still opportunity in that 12 billion that gets written off, for some of it, maybe 50% of it, to actually try and claw it back. Still on credit quality, we are adequately provisioned with sufficient coverage across all our loan classification buckets. Generally, if you look at our watch, which is a stage 2, and our non-performing loans, watch at 17% coverage is quite a sufficient coverage for that category, and our non-performing loans at 55.2%. We've said here before that if you layer on the collateral from what we are holding as provisions for these non-performing loans, then you're more than adequately covered. You'll actually have more than 100%. But we all know that when you get to resolution, collateral realization in this market does take an inordinate period of time. But we are comfortable with a 55% coverage at close of 23. Our near-term target is always to be around 60% coverage on our non-performing loan stock. So we dived a bit deeper into the credit quality so that we could answer the questions that we've seen emerge from yourselves around the state of our book. Are we adequately provisioned? Where is the non-performance coming from? And lastly, there's always a question about which sectors are these. I think when I think through that dip of 13 billion into NPL, it's just mainly manufacturing, trade, and there's a component of also personal loans in there now creeping in, but mainly manufacturing and trade. If I turn back then to a bit of our income statement, 23 was obviously quite a difficult year. I mean, a lot of you are seized with the very high interest rate environment. You're seized with the other macros on currency and growth. I think the short end, by the close of the year, interest rates were closer to 15, 16%. Whether you looked at the 91-day T-bill, you are closer to 15 or 16%. That is then our marginal cost of funding in Kenya, for example, and this was true for all other markets. So there was real pressure from a cost of deposits, especially marginal cost of depositories, because that's where a lot of your corporate customers will demand to get a return for the money they keep with you. So a 5.6% cost of funds across the group jump from 4.4% actually speaks to that shift in especially the short-term interest rates in the market. Now, are we able to transmit that entire cost of funding to our customers? The answer is no. And actually, we do pass on a significant benefit to our customers by absorbing a large chunk of that incremental cost of funding. And that's why you'd find that then the yield on earning assets, right, has grown and has expanded, but probably not to the same tune or magnitude as the cost of funding, right? And we've had, I would say, a good growth in our NIM from 5.7 to 6.1%. across the group, but there's obviously a pressure from a cost of funding perspective. From the number side of it is, I think we continue to see our net interest income grow. I mean, from 30.6 to 34.5 billion or 34.6 billion, 13%. Where is that from? Interest income, which will talk to both the lending growth and the rate increase, the yield increase you see there, plus just the volume of growth. And then cost of funding as well, which is a significant increase across the group. But again, that's explained by your cost of funding and also the growth in our deposit base. Yeah, so again, two key drivers there. On the deposit side, I think the strength of NCBA and the foreign currency deposits that we hold and transactional volume growth really was a key driver of our non-funded income outcomes, even as the FX margins moderated in last year versus 2022. I think we've talked about the lending and where that lending has come from, but on the right, again, if you see the growth in our non-funded income is a slight dip over 2022. FX income across the group showing a reduction of 4.1 billion. Really key driver, you've had lower margins. We've all talked about the dollar situation in the country for most of 2023. And we all know that 2022, from an FX opportunity, was actually a good year, and especially for us. But the good side is that our fees and other income growth actually has almost more than covered for that reduction in our FX income. And across, I would say we're more or less close to flat from an unfunded income contribution to the group performance. Before we wind up on the income statement side, I think it's important to also talk a little bit about our operational expenses and the 17% growth in OPEX. This has been an investment cycle of our strategy, 2020 to 2024. We did say it's an investment cycle. I think we have invested significantly in technology, whether it is technology infrastructure, applications, modernizing our technology, investing in the security side of that technology. We have invested in branches, and John did put up a slide where our branch outlay is. All this too as well meant that you have to invest in software that is driving them. That's the people, right? If you open a branch, you need people to man the branch and run it. If you're improving technology, you need to monitor it and all that. So there was also an investment in people. I think you must have seen over the last 2 years, we've done significant investment in our brand as well, right? So the increase of 17% in our operating expenses has an element of investments, but there was also business growth. The growth you see in lending means that there are some operational costs that are going to fund and will be required to drive that growth on the top line. So some of these are just volume-related expense growth because of the growth in our business. And then lastly, of course, you've had inflation and also just the currency depreciation. Some of the expenses that we incur that are dollar denominated, then in 23, obviously, from a shilling perspective, have been higher than even if you looked at constant dollar from the previous year. So we thought it's just good to give you a sense of where is that expense growth and why. And I hope that gives you some color about that. So there is pressure on our cost-income ratio, but still within target. I think our target at 45% for the group, landing at 45.7%. But obviously now is an extraction of those investments and make sure that they start contributing positively to the top line. And we have to go after this with discipline and be able to dial back if any of those investments are not contributing as we do expect them to. As I get towards the end, I think from capital adequacy, the group is really adequately capitalized, giving us real opportunity to go after growth We do not have any constraints. If you look across our markets, Kenya, from just the regulatory capital, we have 300 basis points of capital buffers, and this is after the dividend decision at 17.5%. Uganda, you're all aware, Uganda has increased core capital requirements in that market, but we are sufficiently capitalized in that market. Tanzania as well, with the recapitalization we did in 2022, we have sufficient buffers there. We are keeping pace with Rwanda, and it's simply because of the pace of growth, right? Not because of anything else. I just said the balance sheet was up 56%. Their lending was up 51% over last year. All that means that then we have to continue investing in that market to actually take that growth opportunity. And so Rwanda is the market that you see possibly from a regulatory and internal, a buffer perspective is lower than the rest of the markets. But I think take away the group is adequately capitalized. We are able to go after these opportunities that we see as we expand our business across our markets. And what does all this mean? I mean, a 24.1% return on average equity for the group. That is a return that's very commensurate with most of the top tier banks that you see in this market. I think over these last 3 years, we have consistently delivered to our shareholders. Earnings per share at 13 for 2023 is almost a double where it was 2 years ago. There's been consistent growth in our dividend per share, 12% growth over last year, and quite a significant growth over where we were 2 years ago. And from even a shareholder gain perspective, our price to book now is close to 0.8, right? So there's a return, but there's also a gain opportunity for our over 27,000 shareholders. So the group really, I would say we are quite pleased with the outcomes of this strategic cycle. And even as we go into 2024, which is the last phase of our strategic cycle. I think that comes to the end of my presentation. I'm sure we'll be able to take a little more questions if you have that were not clear in my presentation. And maybe let me invite back our Group Managing Director, John, to wrap up. Thank you.
Thank you. Thank you, David. Can you hear me okay? Why did David get a special mic? Huh? The numbers that matter, huh? I'm feeling jealous. I wasn't given a special mic. Thank you. Thank you, David. So hopefully, David has given you a very good background to the numbers. So say the numbers that matter. So again, I bring back this to say everything we have said today culminates into this, which is that very strong performance for 2023. And before I go to 2024, I do want to really thank you all in this room, because these numbers will be here bragging about how good they are. But we get to these numbers because a lot of support from a lot of people in this room. Yeah, building brand is a difficult job, building a brand. And it takes a lot of you to support us to build this brand called NCBA. So I want really to appreciate you. And I want you to think, when you look at these numbers, there's some contribution that you've made to these numbers. So it's not just for us alone. And for that, we are truly, truly grateful. Together, we shall continue to build a strong NCBA, and together we shall continue to deliver. What I always urge you is to join the bandwagon. Make sure you're not just giving us a good name. You're our customers, you are investors, all that good stuff. I know that I've seen a lot of you tweeting about us. I hope as you urge other people to buy our stock, you're also doing the same and taking full advantage. So asanteni. So let me turn then to 2024. And I want to give a little bit of guidance for 2024 and what we see. One is obviously that we see that there will be strong macroeconomic growth. As I talked about, the GDP numbers, 5.7% expectation, at least for Kenya. And as I showed, across the region, strong growth expected. We've done a lot of investments, and therefore we do think that that will give us some better payoff this year. So increased payoff from our investments. I talked about the branches that we have invested in and the fact that they have become positive. This year we intend to open 5 new branches, and then we intend to pause a little bit to make sure that we have consolidated the gains from all the new branches that we are opening. There is expectation that we'll reverse to a normal yield curve. I talked about the fact that expectation in the US is that they'll start, the tightening has stopped, and they'll start loosening the second half of this year. We believe here in Kenya the same thing will happen, that whereas we shall hold the CBR at 13% for a period of time, that given where the shilling is and how it has performed, given inflation numbers that came at 6.3% for February, almost within range, 5% plus or minus 2.5%, that we expect MPC will definitely not raise CBR, but more likely will start reducing, not perhaps in the next sitting, but perhaps a sitting after that. However, we see a number of headwinds. I think we all see that the cost of deposits have gone up quite a bit. We don't expect this to stop. So pressure on deposit pricing that we expect to continue. Macroeconomic growth, as much as we have talked about strong GDP growth, it doesn't always translate into what we call Main Street growth, isn't it? You can tell GDP is growing very well, but you still feel a lot poorer. I think when I meet people these days, they tell me they are feeling a bit poorer than they felt a year or 2 years ago. Obviously, the tax increases that we have seen, the levies that are coming along, all those affect our own confidence in investments, and therefore we do see a reducing growth, reducing demand for credit going forward. I talked about tightening of monetary policy, whereas we expect loosening, depending on what happens in the next few months. I think we are watching the events in Middle East and other places. Haiti is one area we are watching what will happen there. That could lead to a reversion to that expectation of loosening. And of course, as you know, Kenya was unfortunately downgraded to the gray list on the FATF list. And that really means that the costs of compliance will go up. We are going to be expected to do a lot more to help Kenya move away from being on the gray list, not to mention the data requirements that has come through. It's not being enforced. We are post the period of preparation. So you've seen penalties start to come through. So cost of compliance is going to go up significantly. So that's another area that we're watching closely. And that, with all that, we still want to give a very positive guidance for 2024. So our guidance is that we expect continued and strong underlying growth for our business. And the metrics that we track closely, being one, return on average equity, which we expect to be above 22%. Number 2 is on NPL ratio. I think everybody's talking about NPL ratio because of the fact that hiked interest rates would typically lead to increase in NPLs. We're giving a guidance that we will aim to come in below 13%. Our cost-to-income ratio, there's another concern because, as David showed, we've had significant growth in cost year over year based on investments, new hires. However, we are giving guidance that we still expect this to be about 45%. We are managing our costs quite strongly this year. Capital adequacy ratio, again, David talked about that, 300 basis points above regulatory limits. Again, we maintain very healthy capital ratios. And then cost of risk. We're still giving the same guidance we gave last year of 1.5% to 2% as the cost of risk. So, and that comes across in the provisions that we take. This really tells you that we manage our risks extremely well and quite predictably. The way we learn, the way we collect, all that speaks to the cost of risk that we budget for this year. So with that, I hope you've gotten a flavor of one, the performance of last year, what we delivered. And again, I thank you for your continued support. And thank you, those who are blogging and tweeting about our performance. We appreciate that very much. But number two is that we're giving you guidance for 2024. Again, we expect strong performance, as you can see, and look forward to meeting with you perhaps half year to give you an update on how we are doing on these commitments. And of course, at the end of the year, hopefully to announce how we have all together delivered. So thank you very much and have a wonderful day. Asanteni.
John. Thank you, David. In what always feels like a masterclass in financial results, I think that has been a robust presentation, very intense, showcasing our results and looking at what we expect for 2024 as NCBA, the bank that says go for it. We'll now get into our Q&A with our four panelists. If you can please help us set up on stage. Natalie, Douglas, let's get ready with the mics. We are ready. Good. Let's go for the Q&A. I can see we are also running a bit behind time, but I'm sure we'll catch up. So let's go for the Q&A. Great. As we set up, I will ask our four panelists, our Group Managing Director, our CFO, our Chief of Staff, and our Chief Economist to please join us on stage. Actually, we can also probably clear the podium. Sorry. Great. All set? Natalie, we can start.
When you get the mics, please mention your name and which media function you're here with.
Good morning, everyone. My name is Sophia from Standard Media Group. And my question, I believe on the results I have gotten, I have understood most of it and I'm okay on that. But my question mostly is on NCBA Bank playing a big role in women's economic empowerment. And we see that most of these women, especially the ones who are in investment, when some of these women want to get maybe credit or loan to finance their businesses, they find a big hindrance in credit scoring, and perhaps sometimes even being asked to bring collateral. So my question is there an alternative way of perhaps rating or scoring them? Or perhaps is there a way that maybe your banking organization is looking at perhaps rescuing or helping this women? Thank you.
Thank you for that question. And indeed, you're right. One of the challenges we find when it comes to credit for women, I think you've mentioned one of them being that of requirement for collateral. And I think we're still a society where a lot of the collateral would be the name of men, unfortunately, right? So that becomes problematic. A number of things. One, I believe that as far as collateral is concerned, I think our laws have evolved quite a bit, and I think it's important for women to always note that these days it's very difficult for a bank to lend on land, especially without the consent of the wife. Yeah. So that is important. Now, I'm not talking about lending to men, I'm just talking about lending generally, that even for men, they can't just walk up, say, I own land and I'm going to borrow, I have collateral. We these days require that a consent be availed by the wife or wives, for that matter, towards using that collateral, for the man to use that collateral. That's important. But to address the particular issue about on women, let me start by saying that when we rolled out the digital lending products, especially M-Shwari, what we found with M-Shwari is a lot of consistent and return borrowers tend to be women. Why? Because on M-Shwari, one, you don't ask for collateral. Number two, you borrow in a very dignified manner. You don't have to come and beg a bank employee for 50,000 shillings, something that you do in the comfort of your house. And of course, number three, that a lot of the daily businesses that we see are driven by women. And so I'm sure it's very useful when we borrow at 4 or 5 a.m., buy their wares, sell and repay by the end of the day. So what that tells us is women actually form extremely good credit, if you may. They're very good, debtors, if you may. And so one of the things we have looked at is expanding the amount that we lend unsecured. So, for example, on our Loop platform, we can lend up to 3 million shillings unsecured. And through that, we do a lot of credit scoring that based on behavior. And when you do credit scoring based on behavior, women do tend to come on top. They do a lot better than men. So I think the products that you see that are geared towards women are those that require less, that depend less on collateral, but depend a lot more on behavior. And that's something that we're doing. The other commitment we have made is on the ProPaco loan that we signed of 50 million. As you saw here, we say 30% is going towards women-related businesses. We've been challenged and agreed with ProPaco that will come with specific criteria to lend to women, and we'll be announcing that criteria that will make sure that 30% of that funding is available for women-owned or women-related businesses. Thank you.
Thank you, John, for that. I think we'll just have a moment to put some water on the table. And the next hands up. Anyone else with a question?
So, good morning. My name is Kefa Moirore, Nation Media Group. Two quick ones, I think, to the group and the CFO. So my first is around your provisioning. And to John, maybe should I read this as some optimism to the direction of non-performing loans going forward, noting that yes, we've seen a bit of pressure if you look at NPLs from a gross perspective, but at net terms, it's 12.7%. The provisions are down around 30%, and of course, that has been explained in the slides. And from your opening statements, you had mentioned that perhaps you're not seeing, the CBR rising any further, and perhaps we should see some cuts somewhere in the future. So does this speak to perhaps your optimism that the pressure that has been driving up NPLs will reverse? Then my second question is around your non-funded income, NFI. Since quite the slowdown, of course, from Forex income, we know the momentum that had led to that, that line going higher. But the question for me now is, if you drive a manual car in second gear, and FX income had been in third and fourth, you're back at second gear. What's the third and fourth gear? How do you get back to that growth in NFI without perhaps FX income rising again, as has been the case for the past 2 years? Thank you. So what's the new momentum for NFI, you think?
Thank you for your question. I think you started by sort of clarifying that you have sufficient detail on the non-performing loans for the group at 12.1%. And if I read your question well, you're saying, why are we so bullish that it should be around that range, 12-13%, despite what we expect in the macro environment, right? I've got to read this also in context of some of the tailwinds the headwinds that John did put up, right? Some of the risks. If you look at 2023, there'll be even an element in our provisioning book just as a result of that currency depreciation, right? Because if you have dollar-denominated facilities and you have shilling collateral, what happens is you end up having a mismatch, even if you are well covered and you have to provision. So part of the banking provisions, actually a significant component of it was due to that FX element. So if that holds, and I think that's why there's that conversation around if the macros hold, then you should be able to eliminate that element of provisioning, for example, right? I think secondly is there is, in our provisioning number, there's an element of our digital business as well in their digital impairments. Now, you cannot look at digital impairments the way you would look at a normal banking operation. 930 billion of credit extension. So we look at what is the loss ratio sort of on that portfolio, right? Right now we're at about 0.4%. Okay, we've had some very good and stable sort of outcomes on that digital extension. And I think from what we see going into 2024 is that this should hold, right, into 24. So I think the 13% ratio is informed by that. And lastly, that when we look at our stock of NPLs, there's a lot of remediation going on. There's one or two names in there that we know have been on the right track, are still held in there, but have been on the right track. And so we expect to upgrade them and don't expect a significant downturn. So I think when you layer all those three, then we get to round about the guidance that John did give. I hope that sort of provides some color on that, yeah? I think the next NFI, FX maybe, Rafael.
So thanks for the question. I think you've noted correctly that we did budget for slower FX sort of revenue on account of primarily the expectation that the exchange rate troubles were going to normalize. And indeed, as you can see, more recently, that has actually been the case. But more specifically for 2023, because that's the reporting period, the exchange rate did actually attempt some bit of increased liquidity if you compare to 2022. It's important to always bear in mind that the prices, particularly exchange rate as a price, will be noisy. And as long as the fundamentals stabilize, that noise sort of fades away. So if, for instance, you look at just this past 6 weeks, you are seeing that noise going down on account of the taking out of the default risk, which primarily has driven those fortunes. So I think the way you make money in FX will go back to basics, which is either you drive your turnover, you drive your volume. So if you look at our strategy that John spoke to, that escalation in terms of our retail franchise, driving our retail base to 23% contribution is going to buttress and give us significant cash area for FX revenue. And I think if you've seen, even though year on year we've reported that sort of drop, you will begin to see that actually trend towards back to the number one position where we were in 2022. So everything we see right now is going back to just the basic fundamentals in terms of driving the turnover side. And then, of course, assuming that margins will remain compressed because the liquidity scenario is improving primarily. But let me just say this as well, because I think this is important for the room. The primary driver for Kenyan macros has been the default risk, all right? So we did see beginning of the year, the guidance everybody provided is as we move towards June, you'll see a lot of noise in the prices. That default risk has been taken away decisively. And if you see the movement from a high of almost 165, we are down to 131 as of last night and this morning. That is almost 20% exchange rate sort of Kenya shilling appreciation. The question, of course, will be, have we now overvalued the currency whilst we had undervalued it previously? I think that the real equilibrium exchange rate will find its own equilibrium point, but you can see foreseeably in the short term, at least in the 130, 135 range that John was speaking to in his operating environment remarks, is where we see tarring. That gives us sufficient room to begin now even product innovation around risk management on currency outlook as well. So there's significant leeway to still drive NFI on the FX front. Thanks.
Kefa, if I may, and thank you for joining us. So building on your question, you were almost intimating, are we running on the spot from an NFI perspective? I think what we've demonstrated today is that we have a very diversified business, and even our NFI lines are very diversified. There's not an over-reliance on FX as a revenue source for that line. In David's presentation, you saw that we've gone up about 2.9 billion from other fees. That demonstrates the activities that we're driving with our customers on the core banking side, to do standing orders, to become more of their primary banker, is generating us revenues. And as we continue to invest in better technology from a customer perspective, the corporate internet banking solution that we'll be rolling out, new retail banking capabilities, all of that will make us a more sticky relationship and creates a lot of value for the business to unlock those other NFI lines. So we're not concerned from that perspective.
That's excellent. Thank you so much, Louisa, for that. I think it's also good that we recognize some of the questions that are coming in online on YouTube. So we have 3 questions from Jesse Ludenio. I think that came on early on during John's presentation. There's a question. He said he noticed that there's been some peculiar balances due to CBK of 19 billion Kenya shillings. So would you be able to paint a picture of what this is all about? And how much are you looking to spend on the AIG investment? And how far are you with that? So that's the first bulk of the question. Then there's a second one is, most banks choose to build in-house capacity to offer insurance. What's the idea behind an acquisition of AIG? And then on third, at a time when NPLs are rising, what triggered the improvement in your loan book? So that's the third one. Yeah. So the first one is on the peculiar balance of 19 billion from CBK. So what's that all about? Then we speak about AIG investment. How far have we gone with that? And what's the idea behind acquisition especially? And then loan book.
Thank you, Jesse. I think let me start with the AIG question because I think I sort of answered why we are doing AIG. I think I went through that. The 4 strategic drivers. I talked about the fact that universal bank model, our customers are asking for these products. They want one place shopping. They don't want to call somebody for insurance, call somebody for investment, call somebody for deposit, call somebody for a loan. They want to talk to the same person who understands their full financial need. And that's been a big driver. And of course, I talked about the fact that our own offerings, both the breadth of our outlets, the reach that we have, we believe we're able to expand and offer a lot more customers these products. I talked about our asset finance business, our corporate business, being the biggest consumers of insurance products. And the last point I believe I made was the fact that using digital, we can indeed expand our offering to include a lot more people than we have today that are benefiting from insurance products. So those are the reasons I gave as to why we went into AIG. I do not want to disclose how much we are paying for it. We will be disclosing that very soon, but our agreement with AIG is that we do not disclose that until the deal is done. So I'll not be able to disclose that, unfortunately. Turning to our balance sheet, yes, indeed, good observation that in our balance sheet at the end of the year, there's a line there called due to central bank, which shows an amount of 19 billion shillings. Let me start by saying this, that I think you all know and have heard that there has been a dearth of liquidity in the industry, and indeed in Kenya, which is part of the reason interest rates have been going up, deposit rates have been going up, because there has been a dearth of liquidity. And because of that, central bank does provide liquidity to the banking sector whenever the banking sector needs it. And so what you see, and not just our results, I think you can check across the industry, is most banks do avail themselves of the what you call the repo window available at the central bank. Yeah, the repo window, you're usually given money for 7 days, I believe, for 7 days typically, and you repay it. So depending on when you do the cutoff for reporting your balance sheet, you may have gotten some liquidity from the central bank. So I think what I'll say is that the central bank also does report on their reports how much liquidity they have given to banks, and you see, I believe at the end of the year was it 150 billion? Was a significant amount that was given to banks at the end of the year. So just to say that we availed ourselves to the repo window, and this is regular banking activity. It's not unique for that day. It's something that all banks do on a daily, regular basis.
John, I think there was a question just on the AIG side with regards to where we are with the transaction.
Yes.
We have submitted our regulatory applications. Pending those approvals, we'll provide an announcement on the deal. I think the third question that was sort of layered in there is, why are we doing this in-house versus a standalone business? And what we've demonstrated is we're really good at running non-banking subsidiaries, right? So year-on-year growth of 40%, over 70% return on equity on these peripheral businesses demonstrates that this universal banking premise is that you can extract value at a lower investment just by leaning on those relationships, unlocking your distribution, and so on and so forth. So our historical experiences with non-banking subsidiaries gives us confidence that this model can actually work even on the insurance side.
And last year on NPL, I believe David had tackled that question.
David, yes, there was a question on the loan book. So at the time when the NPLs are rising, what triggered the improvement in your loan book? So that was that question from Jesse online.
NPLs rising, improvement. Okay, I guess these questions must have been before the presentation. So I gather a lot of them were answered through the presentation, but we did go through that even a few minutes ago. Your NPL ratio is a function of your stock of NPL and your lending portfolio. Yes, we've had a slower growth in our NPL stock, and our lending portfolio has grown faster, right? That's one, because it's just pure ratio. The second, obviously, then, which we discussed in my presentation, was what you look at. What is our net increase in NPLs from a perspective of what names deteriorated, right? I think I said we had a net deterioration of 13 billion, which means that's the net of improvements we made. Some names get remediated, some people pay off, but the net was 13 billion, right? So it's still not necessarily that we're very happy with that net deterioration, but we also then, for various reasons, wrote off about 12 billion of non-performing loans. Either because we had reached the end of the resolution with the customer, we have realized collateral and you have a shortfall, or you've then reached the end of the litigation process with the customer. And so the right thing to do is actually then move that off your book. So that is sort of explains the flow of the non-performing loan stock. So there was some deterioration in the book. I mean, we're not saying there was none, but we also grew our lending portfolio.
Thank you for that, David. I think we'll take 3 last questions. So I have one here and over there.
Yeah, a couple of questions. One, my name is Eric Mokaya from Mwango Capital. Oh, I should stand. So a couple of questions. One is for the held to maturity on the GOK securities. If they were marked to market, how would that look like? And what constitutes the other securities in the HTM in line 5AB, I think, of the CBK format? And then on the Eurobonds, did you have any uptake of the latest Eurobond issuance by the government? And then what was the holding for the 2024 Eurobond as of 31st December 2023? And then some questions for Gashora. One is on the inflation is sticky both in the US and in Kenya. So I don't know what's the basis for expecting the CBK to reduce rates later this year. And then you had talked about customers leaning towards overdrafts. Has that changed as the risk on default has eased in the past month or so? Are there customers more leaning towards investments and less towards overdrafts just for day-to-day business? And finally, the shareholders are saying that you've reduced the DPR from 50% to 36% in a period where we see increasing substantially. So why would you cut on their dividends when you know that ROE, the company is doing well?
Maybe Rafael can take the securities question, and then I'll supplement the mark-to-market.
So thanks. I think so first of all, the HTM portfolio is, there's no requirement to revalue it on a day-to-day basis, but you've seen the shift on interest rates that's taken us to just over about 7.4 billion in terms of mark-to-market realization on that. The treatment of it is to hold it to maturity. So there's no expectation that you'll be using it for normal trading activities on the HTM book. Yeah. Thanks.
Yeah, and possibly, I mean, if you're referring to the financial statements, you've got a line there, other reserves, right? Those reserves, the negative reserves under other 4.7 billion is basically the mark-to-market on the AFS portfolio, right? Or what was sorry?
It's other securities under HTM in line 5AB. And then on the HTM that you talked about, it's about, I know like it's supposed to be held to maturity, but what's the impact if it's marked to market, especially given the happenings in the US last year? So that was a question there.
So
So I think the way I can answer that is to say that because we are not required to value an MTM, we have not valued an MTM. However, I think it's good to say that if I were just to guess, I would say that our investments are typically about 50-50 between AFS and HTM. So if you look at the effect on AFS, it won't be too different on the HTM book, right? Okay, but we don't typically value it. Okay. On your question about Eurobond, I think has been answered. We did not participate in this new issue. Yes, we had bid, but we did not get allocated. And in terms of our exposure to the one maturing in June, we had $34 million exposure. And of course, we tendered and most of it was repaid. So I hope that answers that question. You've asked me two questions, or three actually, one on inflation. Yes, I think if you look at inflation, actually February in Kenya, it came in at 6.3%, yeah? In January, yes, it started peaking from December. So you see December was 6.7, I believe it went to 6.9, then it's now 6.3 in February. We're waiting for the number for March. Price of petrol has come down, as you know, isn't it? Price of fuel. And that usually has a very big influence on our inflation in the country, right? The price of food is also been dropping. That has a big bearing on our headline inflation as well. So because of that, and the last one is that if you look at MPC release in their last meeting where they raised CBR, they sort of steered towards the fact that they were raising CBR because of the performance of the shilling as opposed to just inflation, yeah? The shilling obviously has performed very well since that meeting, as Rafael has said. Inflation, we have seen it come down, as I have said. So that gives me, that creates the expectation that even though CBR may not come down immediately, the prospects of it continuing to rise is quite low. Okay, so that's what I mean. And also, I think you see in the last two auctions that you see there is some concerted effort from the CBK not to take very high rates of very costly money. Again, saying that they are starting to control interest rates, yeah? And by that, I mean they're trying to drive rates to, they believe the rates are peaked, essentially. That's what I mean. So that gives me the belief that it will stay where it is for a period then, but the expectation would be, if it moves, would be downwards as opposed to up, okay? The US, sort of the same. I mean, the expectation was it will come down quickly, then it changed to inflation started going up a little bit, so people say it will stay high for longer, but I think now the expectation is that aiming because of one, the expectation on inflation, the job market, and of course we cannot rule out politics, that they will probably start dropping rates sooner than had been expected. So I hope that answers that question. Overdraft versus investments. What we are seeing, and I think you've heard me say this before, is there's more borrowing on the short term, which is the overdrafts, than the long term. So people are borrowing more for what I call daily spending. And by people, I mean even businesses, for daily spending than for investments, okay? This is owing to the fact that short-term liquidity is very tight, even for businesses. So that's what we have seen. And if you've seen what I've talked before, is I'm cautioning that at individual level, we need to be very careful that we're not borrowing to spend. Individuals should borrow to invest, not to spend. Really, your daily earnings should be enough to cover what I call your daily needs, yeah? Don't borrow to go buy a beer, for example. That's what I mean. Okay, but we are seeing cases where people are borrowing to just spend, and perhaps part of the drive of the growth we have seen in our digital lending, a lot of it is just for daily survival, which can be problematic. Lastly, you asked about dividends per share, or rather dividends payout ratio, right? That's what you're asking about. So yes, it has reduced from, I guess, 50% last year was 51% to, I've seen calculations saying about 36%. We don't usually do those calculations, but you all sort of do them. We've talked about investments we are making. We have talked about investments in AIG that we are making. I talked about a number of other investments that we made on digital. What we did not talk about, actually, I think David mentioned the capital adequacy ratios that we like to maintain with our businesses. So a lot of the funds that go to support maintaining those large capital buffers actually also come out of this profitability. So our waterfall allocation is usually compelling investments on top. Yeah, we have AIG investment to make. Number two is investments to maintain our board mandated capital ratios in all our subsidiaries, right? So that's the next thing we do. And only then do we go to look at dividends. And so it's that calculation and then results in the amount that is available to pay the dividends. So that's how we come up with that answer.
I think, Eric, you had one clarification and group perspective. I'm sure you understand what's sitting on those other securities will be the other entities or other regional entities, the investments in the sovereign instruments in those markets. But for the Kenyan entity, this should be the corporate bonds that we also have some investments in.
Yeah, and just to close, so just to emphasize our guidance on the rate outlook, the policy rate. If you listen to the Fed last week, their own projections are at 4.6 by end year. It's from the current 5.5. So that's the guidance they provided. If you recall, domestically, we went up to close the differential and address the exchange rate expectations, including inflation, as John was explaining. So taking those two, it's obvious to us that when the MPC meets next week, the correct thing to do, because you're potentially benefiting post-June on that reduced differential, is to hold and see the full quantum of your 400 or 350 basis points seep through and address the adjustments on either side. Because if you recall, the actual problem is on the fiscus. Okay, so as the fiscus corrects as well, the exchange rate is now performing, as John has mentioned, 20% appreciation, and that's giving them significant hope that actually the 5% inflation target is very achievable, not only in March, but potentially as early as April. So that then tells you that if you are sitting at the MPC, the correct strategy would be to wait and see the full impact of your pass-through effects, and then you can correct costs in the next iteration of the rate cycle. Thanks.
Good morning. My name is Ronnie Choka from AIB Axis. Congratulations on the good set of numbers. Yet my attention is drawn to three aspects. The first one is the Tanzania case. So for the past, 6 to 8 quarters in a row, we've had a bit of lag on the performance of the Tanzania market. What do you attribute this to? You still see you have relatively small physical presence, just about 4 or 5 branches in Tanzania. Is this intentional, or are you intending to scale up your presence there? Or because typically I notice you play basically digital for volumes and legacy for funding or inexpensive deposits. Do you kind of look to replicate that strategy there? And if so, how do you intend now to lower your cost to income ratio from the 70% levels you're seeing as of today? The second aspect we're looking at is, I noticed that there's this, despite the slide presented on increased cross-border trade, we notice a counterintuitive decline in Forex earnings. So what do you attribute, what's the attribution of this downtrend? Is it attributed to lower volume, lower margins, or was there kind of disruptions on your supply chains mid the year or in the course of the year? And lastly, it's regarding the conspicuous surge in interbank foreign placements. with a disproportional increase in interest income from interbank placements. What informed that strategy to kind of offshore deposits at this point, with to only earn but less in return? Thank you.
Yeah. Sure. So I'll speak to Tanzania. So I think maybe about a year ago, we started to speak about what is our turnaround objective for that market. We'd been there for over 10 years, had posted losses year on year, and there was an opportunity for us to really take a deep dive into where are the opportunities as a multinational. We are considered a regional multinational playing in Tanzania versus a local player. Versus the local incumbents. And the realization for us was that retail is very challenging. If you're doing traditional retail, in the form that we do it in Kenya, you require a significant branch network, you need significant investments in the brand, and so on and so forth. So the narrow space that we see, that we think is very profitable for us going forward, is on the corporate side. This is where your expertise in transactional banking, your expertise in offering sophisticated advisory to corporates from a working capital solution perspective, as well as capital planning for long-term purposes, can really differentiate you in a market. So what did we then do? We decided to shrink our presence from the 12 branches that we had, focus on just 8, focusing mostly on Dar es Salaam, and the major provinces or cities. And that has helped us actually move from a cost-to-income ratio that was above 100%. So the 70% that you see on the screen is actually a significant improvement through that rationalization exercise that we conducted. So what does going forward look like? We're very bullish that the business model is actually bearing a lot of fruit. If you were to look at the Tanzanian income statement, top line has actually increased despite that smaller footprint. So it tells us that we're on the right course. Cost to income ratio is on a good trajectory, but more importantly, the NPL outcomes are also well contained and give us confidence that the new credit risk that we're bringing on board is not going to burn us in the future. So net, rather than have a Me Too philosophy in every market that we operate in, it's important that we ask ourselves, what's the path to winning in that market, and retrofit our strategy accordingly. And that's what we've demonstrated in TZ.
So thanks. Just like we were saying earlier, the FX revenue, just lower year on year, is primarily because of reduced margins. And you'll see that across the industry. That's one. But also just the first half of the reporting year was relatively less noisy than the last. So compared to 2022, the level of noise was also reduced. So you make money on FX based on volatility in question. I think the central bank has done a very decent job in trying to reduce that noise, which is their mandate. And as long as that reduces, you'll begin seeing compressed margins, which is why we are betting heavily on our retail strategy to try and drive the volume game. So even if you hold the spreads constant, you then are able to still achieve that level of growth. Primarily, it's a spread game. Thanks.
Okay, I have one final.
Oh, sorry.
Sorry, just ask that again on the dollar.
The interbank dollar placements, the increase year over year.
I mean, we have significant foreign currency business. So with growth in that, you'll begin to see a lot of growth in that number. And typically, because you're managing your liquidity prudently to make sure that most of these are customer deposits that you'd expect. So you want to balance your liquidity profile in a way that caters for withdrawals from time to time. But if you see across the industry, particularly in our book, there's been significant success with regard to foreign currency deposits. So that explains that activity.
Perhaps I wasn't clear, but my question was regarding the reason behind the tripling of interbank placements abroad with only but a double return on interest income from those placements.
Okay, so the longer in the curve you go, the higher return you can get. The typical bank balance sheet headache is you want to manage that expected higher end of the curve return vis-a-vis liquidity needs in the short term. So most of our placements have tried to balance that to make sure that we are liquid. We have significant liquidity buffers to be able to address any potential withdrawals. Of course, if you look at the operating environment, that informs that kind of prudence, because there's a lot that is happening externally, even domestically. And so our expectation with regards to net foreign assets, for instance, which is where foreign currency deposits come in play, had to balance between the risk of a fast changing operating environment. So even though you are deploying, your limitations are on the short-term placement space, which of course denies you some yield pickup, whereas you could have gone higher on the curve and a little more.
Yep, I'll just add, I mean, we had if you look at the presentation, a very strong foreign currency deposit base, right? Very, very strong foreign currency deposit base. The macros in G23 led to very mixed customer behavior. Some of customers who even had dollar-denominated lending wanted to get out very quickly. So what happens? You're creating much more dollar liquidity because people are saying, I want to convert my loan to shilling. I don't know where this rate is going, and at the end of the day, it may be very, very, very high. So you start finding that the stock of our dollar lending actually went down, while you have very, very strong mobilization on the deposit side and customer balances. Now, as Rafael says, in the short term, what are you doing? You'll hold that liquidity, but you also want to be very cautious about where do you invest it, right? Especially given that volatility. Do you go and say, I now want to go and take longer term dollar investments? No, you probably sit back and watch a bit. So you will see some sort of correction on that in the near term. But that's sort of the end of period kind of play. I hope that sort of gives you a better sense.
Yes, so this is directed to John. Obviously, it wouldn't be NCBA if we did not mention your election into KBA as chair. So we wanted to get the perspective from the KBA on what are your comments of the overall banking performance versus the suppressed economy, touching on anything taxation, the exchange rates that have been so volatile, as well as Forex market. So yeah.
Si tuonane nyuma ya tent. That question. No, thank you, Natalie. What I would say is this, that obviously one of the concerns we've had as banks is exactly that we're going to be announcing very good results in a depressed economy where everybody else feels that this is a terrible time for businesses, for livelihoods, and we're here announcing and bouncing on these very good results. But what I want to explain is that our view, and I've said this before many times, is that you want a strong banking system to help in the revival of the economy. So we should actually be celebrating the fact that we have a very strong banking system. And because you have a strong banking system, we know that our economy will be sufficiently served to recover. If you look at the borrowings that the government has been doing, yes, it's been expensive, but can you imagine if banks were not there to support that borrowing and make that money available for government to pay salaries, for companies to pay their salaries? So it's very important that we have very strong banks that are able to support the economy. So for us really is that Kenyans, we should be proud that we have a strong banking system, a very stable banking system, one where you know that those who have businesses can count on for support. So that's one thing I would say. I think the second thing I would say is this, that the taxation that we see, which everybody's talking about, rising taxation, the levies that are coming through, I think, and I've said this before, they're very painful individually, but they're necessary from a macroeconomic perspective. Our debt stock as a country has been rising especially because of the weakening of the shilling. The company holds about 40-something billion in foreign dollars in foreign debt. So every time the shilling weakens, just one shilling is an addition of 40 billion shillings of debt to the country. So it's important to note that. And then for us to pay that, it means that the only way government can raise additional revenue is through taxation. We need our country to be able to pay those debts. We don't want them to default. That's the last thing that we want. And if they are to pay those debts, then the only way they can pay those debts is to raise revenue. And the only way to raise revenue, unfortunately, is to tax us, is to impose new levies, as we have seen, because they are not in any other business as government. So what I would say is this is short-term pain for long-term gain. I do believe, and as you have seen, our outlook for 2024 is actually quite positive. As banks, we stand here to support our customers. As KBA, we have talked a lot about the fact that even during COVID, we were able to come together and support our customers. Whereas this is not as acute, it's important that we stand with our customers. We will work on those who have loans. People have asked about NPLs, increasing NPLs. We think there's a way we can work with our customers so that those NPLs don't become a reality. Whether it's giving moratoriums, whether it's restructuring of loans, whether it's giving working capital, a bit more of those overdrafts, we're here to support. So thanks, Natalie.
Great. Thank you. Thank you, Natalie, for that question. I think it's a great way to end this session in the week, saying that if we have a strong banking system, then we have hope and optimism for the economy, right? So really thank you to the panelists. Thank you so much, Raphael. Thank you, John, for the great overview on NCBA results for 2023. Thank you to our Group Director on Strategy, Louisa. Thank you, David, our CFO, on the financial results and a deep dive into the numbers, and really great questions coming through from the media team. Ladies and gentlemen, we've come to the end of our formal program for today. Thank you to the media team for making time, for standing with us up to now. We don't take that for granted, as John mentioned. And thank you so much for all the people that continue to work hand in hand with our customers, especially navigating the hard and tough economic times. Would also like to thank our board of directors who continue giving guidance to this esteemed organization and the executive leadership team in ensuring that we cover our strategies and priorities to ensure NCBA continues succeeding. Finally, to the team that puts this together, I always say it looks great on stage, but behind the scenes, it's always a lot of work, including the presentations, including the executives required to deliver the results today. Thank you, everyone. Thank you to the NCBA team, as always, for putting this together, from the different departments, from legal to HR to finance to marketing to the strategy team. Thank you very much. Discmen, as always, thank you for the wonderful setups, as always, at our events. We also don't take for granted Radisson, who have really increased their events, and we are glad that they continue hosting us today. Thank you very much. Finally, to the panelists, thank you very much for addressing today's questions. If there's anyone that has more questions, please feel free to interact with the executives. We'll now close today and thank everyone for being here. Asanteni sana, tuende mbele, and enjoy. Have a good break for Easter ahead with your loved ones. Thank you. We'll now move to the photo op. If Natalie, you can help us. Have a great day, everyone. Thank you.